This was my first target on this pullback here at 39.48. We obviously hit it. We bounced. Now we're starting to break lower. My next target is 38.45. After that, we're looking at 36.95. In 1979, this beautiful move up. Then we had this consolidation phase. In 2025, we had the move up, the consolidation phase. Then literally in 1979, we had 9 months of upside in gold. So 9 consecutive months of up. 1, 2, 3, 4, 5, 6, 7, 8, 9. And we had this big correction. Look at over here. 1, 2, 3, 4, 5, 6, 7, 8, 9. And lo and behold, we're now correcting. And so we are mimicking the 1979 to 1980 top in gold. If we look at how deep the pullback was before we kind of got our first big bounce in gold, it basically went back to essentially that major pivot high right here where we consolidated, right? And so here you can see it pulled back right there. Okay. So the idea here is the same thing could be replicating where we pull back to about 3,500 and then we start our next leg to the upside. Now, I do want to make this clear is it is different this time. We could be looking at gold in a few years at 10K. I don't think that is out of this realm. I do see silver potentially at $100 in a few years.
Gold prices have recently surged above $4,000 before facing a sharp pullback, while silver continues to test the $40 level as global tensions and inflation fears drive safe haven demand. Analysts say the recent volatility could signal the start of another explosive cycle in the precious metals market. Investors are watching closely as central banks continue aggressive gold accumulation, signaling potential long-term strength despite short-term corrections. In this episode, veteran trader Gareth Soloway, known for his precise technical analysis and market foresight, breaks down the current gold and silver patterns, revealing how today's charts eerily resemble the 1979 to 1980 bull run. Gareth points out that just like then, we're seeing 9 consecutive months of upside followed by a healthy correction phase. According to him, gold could retest around $3,500 before its next massive leg higher, while silver holds the potential to soar toward $100 in the coming years. The message is clear. History might not repeat exactly, but it sure rhymes, and the setup is undeniable. Now, we present the clips from Gareth Soloway's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
So gold is usually a safe haven asset. So when things get bad, people want to buy gold. But the problem is people have been buying gold and it's a larger part of their portfolio. And so when we see the stock market decline sharply or the crypto markets decline sharply, there will be some margin calls in those groups, which will then cause people to have to sell some of their gold to cover those margin calls. And I think, again, this is where leverage comes in. People have gotten way over leveraged in the stock market. In fact, I was looking at margin numbers. People are borrowing more money than they've ever borrowed before to invest in the stock market. That's great when it just goes up, but when it corrects, that creates margin calls, and that money has to be found somewhere. And again, I think this is where the case for a pullback in gold comes in. And so you can see on the chart here, this was my first target on this pullback here at 39.48. We obviously hit it. We bounced. Now we're starting to break lower. My next target is 38.45. After that, we're looking at 36.95. And the big level where I will be accumulating in a major way is this max drawdown level at 34.85. At that point, we're almost back $1,000 lower on gold. Now, a lot of people will be hearing this and saying, oh, it's never going to go there. I want to show you guys something that's really, really cool here. Let's take a look at gold. We'll split the screen up here. And I want to show you guys going back to the period here. Let's go all the way back on the weekly to 1979. All right. And this is one of the coolest things. This is how I actually basically called the top on gold back when we were getting to those high levels. As I looked at the chart, and I'm just going to clean this up a little bit here, but I looked at the chart of gold in 1979, and it was identical to the chart that we were currently forming. Now, you might say, well, how is that even possible? I mean, that was 45 years ago. But look at this. Look at how gold behaved going into this period. So you have this, essentially, you have in 1979, this beautiful move up. Then we had this consolidation phase. In 2025, we had the move up, the consolidation phase. Then literally in 1979, we had 9 months of upside in gold. So 9 consecutive months of up. 1, 2, 3, 4, 5, 6, 7, 8, 9. And we had this big correction. Look at over here. 1, 2, 3, 4, 5, 6, 7, 8, 9. And lo and behold, we're now correcting. And so we are mimicking the 1979 to 1980 top in gold. Now, I do want to make this clear is it is different this time. Yes, the pattern is repeating. In 1979 and 1980, Volcker was raising interest rates 18%, 15%. I mean, it was just incredible versus now the Fed is cutting rates. All right. Also, the GDP, debt to GDP was 30% back then. It's 130% now. And so for the thesis here is that while the pullback is going to be deeper than most people think, I actually think we hit new all-time highs in 2026. And so I think it's going to be much more shallow versus in the 1980s. We didn't actually hit new all-time highs, I think, for like 20 years on gold from that top in 1979, 1980. So I don't think the pullback will last as long, but I still think we'll retrace. And I just want to show one other thing here on this chart is that if we look at how deep the pullback was before we kind of got our first big bounce in gold, it basically went back to essentially that major pivot high right here where we consolidated, right? And so here you can see it pulled back right there. Okay. So the idea here is the same thing could be replicating where we pull back to about 3,500 and then we start our next leg to the upside. And so anyways, at least that's my view on it, is that I'm a big long-term bull on gold. I've been holding gold for years and years and years. It's great to feel like it's finally paying out. I'm sure many people feel like that, but it doesn't mean it's immune to pullbacks. We just have to be realistic about it and then buy those dips. It's far different than the 1980s. In the way it is. And I think that's why the base case for me is this is a pullback where we should see new all-time highs in 2026. So yes, it's going to be a pullback where it could come back as much as, another, I mean, we're trading around 3,900 and change. So we could come back another $400, $500. But at that point, I think you have to buy it because you're right. What's the alternative? I mean, are you going to go into treasuries when they're cutting rates? So you're going to get a minimal return on those. I mean, 4%, 3%, whatever it's going to be, especially when fiat's getting printed like crazy by the Federal Reserve. Debt to GDP, like you mentioned, I think those are other factors where central banks are telling us what to do. They're all buying gold, right? And so while gold is reacting emotionally, so you're getting this sell-off and you'll probably have the margin calls causing more selling pressure, people taking a little bit off the table for profits, inevitably the trajectory should be much, much higher. And I still think gold, we could be looking at gold in a few years at 10K. I don't think that is out of this realm, considering a recession in the US or globally. The amount of printing that would have to be done to get us out of that would be massive, and gold would be the main recipient. I mean, Bitcoin to some extent, I think as well, but that's more of a risk on, risk off asset, right? Let's take a look at silver here. Yeah, so silver, and this is, by the way, this is just a remarkable chart as well on silver. So a lot of people were thinking silver would rip higher, way past this 55-ish level. But look at this chart. This is a parallel. So parallel meaning that this bottom line is perfectly parallel to this top line. This is your low in 2008, so your financial crisis low. This is your low in COVID. If you take that line, right, so let's just go back to that and say, all right, here we draw this up and we bring this to the high of the bull market in 2011. It gave us precisely our high in 2025. Now, just like with gold, I think that, you're going to get a pullback here, especially with an pseudo-industrial metal like silver. But I would start looking to buy once we get back to about the $43 level. All right, you have a level here and you have an upsloping trend line in this range here. But these are both levels where I would start to really heavily accumulate. Basically, once we get below 43, I'm buying all the way down as far as it wants to go for that next leg up. Because I still think, again, yes, it's industrial, but it's still a metal, right? So it has to be denominated in terms of dollars. And if dollars are depreciating, by default, silver should go up. I do see silver potentially at $100 in a few years. It's just a matter of you got to flush out the weak hands. And this goes for gold. A lot of people get very upset when you're talking about any asset that they're long pulling back. But there was a point where you saw that parabolic move in gold and silver. And that's where you start to get people that are thinking, oh, this is the easy investment, right? And for those of us that have been long-term gold holders, there's no such thing as easy in gold, right? Or silver. So, those people have to be flushed out, get the weak hands out, get it back to its hardcore level, and it'll start grinding higher again and make new all-time highs. So I do think that the economy is slowing faster and faster. And I think the government shutdown is obviously adding to that. Although the idea is that once it reopens and all the employees essentially get the money, their back pay, then it could stimulate a little bit. But I don't think that that alone is going to get us out of the trajectory of the economy, right? We've seen the repo market from the Federal Reserve. That's the emergency lending arm of the Federal Reserve. Banks have been coming to them. We know that per Jamie Dimon, he said, if there's one cockroach, there's many cockroaches. The idea here is that these banks could be in some trouble, or at least the possibility that trouble could be brewing. And I think these are things that, again, the markets haven't priced in. We're basically at all-time highs, a down day today. But again, price to perfection, where any sort of bump could create a big retrace in the markets. We've seen V bottoms over and over again play out, whether it's small drops on the S&P, big drops. I mean, the COVID drop in March 2020, that was a V bottom. The liberation sell-off low right here on the weekly chart, look at that V bottom. And so we really have basically the markets have conditioned investors. And by the way, a lot of investors have only come in since COVID, right? There was this huge awakening of younger investors coming into the market. Again, I don't want to sound like an old fogey here or anything like that, but there was a time where you could have a bear market that lasted and you didn't see a new all-time high for years and years, but we've got accustomed to it being almost within a month of a big drop. And I do just mention to people that won't last forever. I mean, look at Japan, look at the US in the dot-com era. When these collapses occur, they can be so detrimental. It can take, NASDAQ took 15 years to recover. Now, a lot of people will be saying, oh, well, it's a different market. I disagree. I think human emotion is what runs the market, and greed and fear. And so if it happened before, it can happen again. And I do caution people about being too aggressive to buy the dips now. And I think one of the things that I'm very particularly aware of is that it's not always as easy to just print money forever, because essentially what you're doing is you're diluting the underlying fiat currency. And so the buying power of the dollar starts to depreciate more and more, and there will be implications to that. And so it's not as clear cut as saying, oh, well, if they just print us out of this. They can't always just print us out. Look at Zimbabwe, look at some of these Venezuela, right? These are countries where they did that. Are their economies doing great? Are their people doing great? The answer is no. When you crush the dollar, you will inevitably hurt the buying power of U.S. citizens, and they will struggle to afford basic goods. There's a reason why inflation picked up.
What we're seeing right now isn't panic, it's positioning. The markets are doing what they always do before the next major breakout, shaking out the weak hands. As the charts reset and gold finds support near those historic pivot levels, the smart money is quietly loading up again. Silver, meanwhile, is building energy under the surface, and when that breakout hits, it won't be slow or gentle. The setup is forming, and it's only a matter of time before momentum shifts back in favor of precious metals. So, if you've been watching from the sidelines, don't tune out now. This is when awareness pays off, when knowledge becomes profit. The storm is brewing, and those who understand the cycles will be ready to ride the next explosive wave. Stay alert, stay informed, and stay ahead of the herd. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.